Hey, what's going on, guys? Welcome to today's YouTube video. My name is Ruslan G, and today we're going to be talking about stock splits, what it means for a company when they split their stock, why they happen, and what it means for your portfolio. The reason why I wanted to do this video is because I had some people asking me why Apple and Tesla did a stock split recently. So I thought I'd dive into exactly what a stock split is, what to expect when one happens, and what it means for your portfolio. So without further ado, let's jump right into this one. All right, so what is a stock split? So a stock split is when the board of directors of a company decide to split their shares into half, but double the amount of shares on the market. So the easiest way I've been able to describe this to someone is if you take a $100 bill, right, and you were able to split that dollar bill into half, and now you have two $50 bills. Obviously, you shouldn't do this with your money. You don't actually get two $50 bills, but this is essentially what a stock split is. So now you have double the amount of shares, but they're only worth half of what the total $100 bill is worth. So two shares versus one, half the price of both the shares versus a full price of one share. So nothing as far as value actually changes. The only thing is that the shares either double or triple or quadruple. And in Tesla's case, they actually 5x'd, and in Apple's case, they 4x'd. So that's what a stock split is. So that's the easiest way I've been able to describe it to others, and that's the way I thought it might be best for you to get introduced to what a stock split is. So without further ado, let's dive into why a company might split their stock. So it's in a company's best interest to get investors in the door, especially new investors, to invest with their company. So that way they have more money to grow their front end, right? So that way they can grow their own company by getting investors to invest with them. And that is ideal for any business, whether private or public. And in this case, we're going to be talking about why they might do a stock split. Let's split up. Let's imagine you own a company and you have 100 shares, and those 100 shares are worth $100 per share. Now, if you think about it, at $100 per share, someone might come up to you and say, hey, can I buy a share of your stock at $100? That seems reasonable, right? But let's imagine that those shares get up to a crazy figure like 5,000 or 10,000. And as an investor, it doesn't seem like paying $10,000 for a share of your stock, or maybe even $5,000 for half a share of your stock, is doable, or maybe not even worth it. And if that was the case, then you miss out on an investor, and I maybe miss out on a great company. That is, of course, if your company is great. And if that's the case, it would be in your best interest to go ahead and to do a stock split. Now, using that same example, if your stock is worth $10,000 per share and you had 100 shares and you did a 1-for-100 stock split, now you have 100 times more shares. So 100 times 100 is 10,000. So those 10,000 shares exist, right? Nothing's changed. The hands haven't changed. The only thing that has changed is the fact that there's 100 more shares on the market, and those shares are now priced, instead of $10,000 per share, they're only priced in at $100 per share. Now, me being the investor, I might be more enticed to buy a stock that's $100 per share versus 10,000 or 1,000, whatever the price may be, right? As long as it's smaller, it seems better to new investors. And that's the case with Tesla and Apple, because they were at a really, really high price. And there's other companies that have very, very high prices as far as the price of their stock, but the real value is actually derived from the PE ratio, or looking at the forward PE ratio. And that is something we can get into a different video. And if you'd like me to do a video on that, go comment down below what you'd like me to do the video on, and I might do it in a future episode. So the next part that I want to talk to you guys about is what typically follows and what it means for your portfolio when a stock split happens. So let's recap. The initial idea behind doing a stock split for the company at hand is to entice new investors into that said stock. But what does history tell us that typically happens right after a stock split? Well, in most cases, the initial first day of the stock split, the price actually goes up. So exactly what they intend for the price to do, that's what happens. People buy up those cheap shares. A lot of times, those are the beginning investors or the people who are trying to trade the stock by buying up the shares, increasing the price, and then as soon as the price hits a certain high, they can go ahead and sell those. which is typically what happens on day 2, and sometimes leading into a 1 to 2 to 3 weeks down the road, and sometimes even a few months down the road, where the price actually hits a correction point and it goes down, 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 down. And this can last a day, a week, and sometimes even a month, or maybe even a few years, where the price drops and kind of just floats around in a specific area. And that is why I don't really trade around the times of a stock split, because it can get very, very dangerous and the waters can be very murky and no one really knows what's happening as far as the short-term to mid-term consensus there. The idea for these companies to do these stock splits and why they continue to do them is to make their massive amounts of new shares that they probably hold more and more valuable over time.
Money!
And to entice new investors to get in. So if that's the case, then we know that the long-term perspective of these stock splits is going to be one of very, very positive news, meaning there's going to be a huge rally once again, because the companies wouldn't do this time and time again if this didn't lead to a positive result in their stock price. So once again, if you are investing in the long term, like I and many others in the community do, then you can guarantee that at a certain point, the price of the stock that has split is going to go up over time. And we see this time and time again. Apple, Starbucks, now Tesla. There's a lot of companies that do stock splits for their own benefit and the benefit for new investors as well. So hopefully you guys learned what a stock split is and why it happens. And if you learned anything in this video, go smash that like button, because it really helps out the channel. And if there's anything you'd like to see in a future video, let me know in the comments down below. And without further ado, hope you have a wonderful, wonderful rest of your day, and I'll see y'all in the next one. Peace out.